G'day expats and welcome to another episode 143 today. As always, I'm joined with my co-host, Brett Evans, the managing and founding director of the Atlas Wealth Group, business mentor, mate. He's obviously come back from a pretty interesting concert the last couple of nights, so we'll see where he's been on Tuesday night. How are you, Brett?
Hey, I'm well, thanks. I'm well. It's had the pleasure and the privilege of listening to one Axl Rose of Guns N' Roses down in Abu Dhabi. So
How
it was a
great.
good concert. The boys have still got it, I got to say. I was a bit worried that they come out in Zimmer frames and sort of having their nurses on the side of the stage to keep them going. But hey, whether it's Duff Slash Axel, they're all got it. So full
It's
credit to the
great, mate.
guys.
It's great. Yeah, absolutely. I'm jealous.
Yeah, no, it's good. It's good. And to the folks joining us today, please welcome Mr. James Ridley, who's the Managing Director for the APAC region, my business partner, and my confidant of everything happening in Oz. It's easy to become not detached, but removed from life in Australia. And James is always there with the updates and everything. And he's my conduit back to Oz and keeps me on the point.
Absolutely, mate. Absolutely. And it's been interesting. I've actually just come back from some personal leave. I did a quick holiday, hopped over to Fiji, which was lovely. I love Fiji. Gosh, I want to get back over there to be honest. And we're really
Yeah,
lucky in Australia. It's a very quick flight. So
yeah. Was it 3 hours?
good. It's a little bit more than that. Actually, funny enough, it was about three and a bit over, and then it was four and a bit on the way back, which was weird. But anyway,
Bit of headwinds.
yeah, that's right. Yeah, I was sort of sitting next to my wife Camille, going, "What the hell? It's
Yeah.
taking an hour longer to get back. What's that about?"
That's right. Tell them to put the throttles down, go faster.
Yeah, come on, the afterburners. Let's get in there. So, mate, let's talk about what we're going to talk about today, which is just a bit of end of financial year planning. Probably want to give a bit of a shout out to some of the upcoming webinars that we've got coming through in the next months, to be honest, next couple of weeks. So that's going to come very quickly. So why don't we do that? But before we get into it, a bit of a disclaimer, kicking it over to you, Brett.
And all the information we're going to talk to the good folks today about is should be treated as informational and educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, please speak to a specialist like Atlas.
Absolutely, mate. Absolutely. And it's coming down to the wire where there's another month left, another 4 weeks just over in the financial year 2025. Gosh, this financial year has gone very quickly and it's been an
Been a lot
interesting
going on.
financial year, hasn't it? It has been a
Been a
lot
lot
going
going
on.
on. Yeah, the plate is full.
Oh my gosh.
Elections,
That's right.
tariffs, and that's only in the last 2 months.
That's right. I've been trying to control save my memory, but it's a bit full at the moment for the financial year. But
Yeah.
I mean, we could deep dive into so many different topics, but I think what's probably most important for our listeners is with only a couple of weeks left, it's really important you get on top of any last minute end of financial year tips and tricks and little strategies and just being mindful of a couple of things as well as we wind out that year. But before we jump into probably those significant tips, do we want to give it a bit of a shout out to some of those webinars that are coming up in the next couple of weeks?
Yeah, so next week, my colleague Adam Prentice and myself will be doing a new tax laws, new updates, everything about obviously the incumbent government that's been re-elected with an increased majority by
Yep.
Mr. Albanese. So that'll be
Yep.
next week. And also talking about some of the deeper dive stuff on the end of financial year. So
Yep.
make sure you register for that. That's a good one. Man, we've got potentially Albo for the next 2 terms, maybe three, depending on how the
Mm.
Libs go and whether they can build a few bridges and mend things internally. But he does have a shopping list of items he would like to consider and or execute. And next week, Adam and I will be going through it in greater detail. And mate, yours will be with actually it's a panel of you guys. You want to talk about that?
Yeah, that's right. So we've done it in conjunction with one of the Australian associations over in San Francisco, but they're part of the broader network for the Australian American Association. SF Aussies, it'll be myself, it'll be Tyler Dixon, who is a local US CPA accountant. So he's got a lot of clients over there, a lot of dual clients, dual nationals, but also Australian expats. And then lastly, we've got Tim Sandrossi coming on from OFX, giving us a bit of an update on currency markets because, gosh, we've seen some big swings the last 6 months.
Mm,
Holy shit.
yeah,
So giving us a bit of an update and just, I guess, generally talking about Yes, market update on currency. I'm going to be talking more about the wealth and the financial planning aspects surrounding the US and a lot of the challenges that we help our clients with when dealing with the IRS. And then Tyler's going to give us a terrific rundown on how to manage your taxes when you're residing in the US as well, and probably just being a little bit careful of potential pitfalls, which we often see a lot of Australians fall into. So that'll be a good one. That's obviously that's kicking off Thursday, 12th of June, my time, Brisbane time, but that'll be Wednesday evening for those that are in the US and also, I guess, the Middle East, but it's more centered around US specific topics. So you're not going to get too much value from that if you're in Hong Kong, as an example.
Exactly. Yeah, so I'll put the link down below in the description. So register for that. That's, there's a lot of good contextual information that folks will get out of that. But mate, let's kick on with end of financial year 2025.
Yeah, absolutely, mate. So, I mean, why don't we start off with when do you need to lodge an Australian tax return? Because I still come across a lot of, uh, I guess, clients and I guess generally just new Australian expats thinking that when they leave, I do a final tax return and that's it. I don't need to lodge anything. But I'm actually coming across a lot of expats that actually forget to do that
Hmm.
final tax return. And therefore they haven't declared themselves as a non-resident. And therefore they've somewhat stuck their head in the sand and just said, I'll sort it and come back and deal with it then in 5, 10, 15, 25 years. So don't do that. You need to lodge a tax return when you first leave Australia. And if you're leaving any assets behind in Australia, investments, savings, investments in shares, a rental property, that is still cause for you to continue lodging a non-resident tax return in Australia. And I think that's often very common that people forget that.
Mate, you're spot on. And that's the thing. It's still meeting people, I wouldn't say every day, but at least, a couple of times a week who are either unaware of their requirements to lodge a tax return or they know they do, but it's just in the too hard basket and they're overseas and it's so far from their mind. There's 1 year becomes two, 2 years becomes three, they sort of think snowball from there. And then they go, oh no, I've really stuffed it. If I lodge now, I'm going to red flag myself. And therefore they're at to 5 and 6 years now because they're just sort of stuffing all the invoices under the bed, and dealing with it at a later date.
That's right. So make sure you don't stick your head in the sand. You get it sorted because if you're not lodging, just remember that the ATO doesn't have any issues with, I guess, issuing a fine to you or a penalty, $500, 550, whatever it might be. And then if there is outstanding taxes owed, then, whacking you with general interest charges, those sort of things. So that's an important one. Not only as making sure you've taking care of your tax returns. If you're self-lodging, you've got up until the end of October. But when you're engaging an accountant like Ben Turner is his team over at Atlas Tax, obviously you get a bit more time. There's extensions and that's very normal. But HEX and HELP disclosures, those are often missed because they are required to be done because we need to do a repayment. That kicked in from the 2018 financial year. That's when that legislation changed. Everyone recently has probably enjoyed I think it was a 20% shave off from the
Yep.
government. They've shaved off 20%. I mean, just buying votes then, just buying
Yeah.
votes. Um, but if you do have HEX help, make sure you're doing that disclosure. There's three methods to that, and I'm not going to deep dive into them today because I think anyone that needs to understand three different methods of lodging that, they need to have a conversation with probably Ben because some are easy, but some actually provide a greater benefit, meaning you owe less on your HEX. So in terms of that year. So that's a good one.
Go
And
to our
then
website,
probably,
just saying to the folks, go to our website, and if you go onto the blogs and type in HEX, you'll see we've written quite a few articles on those simplified method, the comprehensive method and all those different ones.
yeah.
So yeah, sorry mate, keep continuing.
No, that's right. Yeah, absolutely. So, and depending on your situation, yeah, some are of great benefit to go comprehensive because it just results in less being paid, especially those in the Middle East and low tax environments. Um, I guess deductions, that's probably the next one. So the most common deductions, which we see a lot of our clients using, usually operates with their super only when they have, say, a rental property back in Australia that might be positively geared. So positively geared means obviously after all your tax deductions, there's still some net income. So, hypothetically, you've got a rental property producing, say, $30,000 per annum. and the interest expense and your council rates, your insurance, those expenses are 25,000. So you got 5,000 left over. If you're considering putting in a contribution into super, well, you're running out of time. You've essentially got 30 days left. So putting in a contribution and making a claim as to it being a tax deduction, and that's saving out-of-pocket tax up to, I believe now that's up to 15%, which is great. But just
Yep.
bear in mind, you just need to double check whether you qualify for that and whether you can actually do that based on the type of super fund you have, because there are eligibility requirements as well.
No, spot on. I think that's the biggest thing is people sometimes leave it to the last moment, a week before 30 June. Oh, I can't be bothered. Do these things
Yep.
now. It's money in your
Yep.
pocket or money in the government's pocket. I know what I'd prefer. I'd want more in mine, less in theirs. So if you like paying 30% tax rather than 15, then by all means, just ignore it. But if you want to, have that meaningful deduction and reduce that tax rate, then by all means, please do it sooner than later. Also, don't leave it to the last moment. If you think about all the super funds around Australia, they're getting smashed with everyone doing the same thing.
Yeah,
So the chance of something going wrong is higher. A chance of your transfer not being receipted properly and allocated properly is higher. First, second week of June, smash it out, put in your calendar, just get it done, and then you got the rest of the month off.
absolutely. Absolutely. This is when it becomes crunch time for a lot of the super funds uh, and they're at the whim of obviously it going into the bank account. That's when obviously the receive date and, if there's weekends involved, it's if the end of financial year falls on a weekend and usually it won't credit then probably until the 1st of July, but you might have sent it in 3 days prior. So you're like, well, I sent it. It's like, doesn't matter. So based on
Yeah.
when it is received. So, you want to be at least sending in all the contributions that you need to. But not only, we're talking about pre-tax contributions here, and I know that's specific to tax and maybe making a claim and claiming it as a deductible contribution in your tax return. But remember, we've only got a month left. Keep reminding myself,
Yeah.
looking at the date. Uh, we've only got a month left, but as part of your strategy, if you're also putting in after-tax contributions, as soon as this year is up, if you haven't put anything in and you're meant to, remember the cap this year is 120,000, you're going to forego that benefit. You don't have a look back with non-concessionals. You have a look back with pre-tax concessionals, but obviously not non-concessionals. So don't forego that opportunity to get that extra amount into super, especially knowing that that indexation is starting to apply to that transfer balance cap so we can have more in that tax-free environment. Won't talk much today about obviously the new super tax that could be forthcoming. We've put out plenty of content on that one, and I'm sure the
Yeah.
boys will be talking about that one soon enough on webinars. But that's an example. Other deductions as we wind out the end of the financial year, prepaying things, especially if you have a rental property. Um,
Yep.
I think that's a really common one, prepaying interest, making sure if you're claiming depreciation, you've actually done the depreciation schedule, you've got everything in place there. Probably having an understanding of the difference between a repair versus a replacement or an
Yep.
improvement. Some can be deducted in full, others can't be. They have to be depreciated. And I know that's a really common one. I think that's probably one we see a lot, don't we?
We do. Someone has a linoleum bench and they decide to upgrade it to marble. You're not replacing like for like. So that's an improvement, not a repair. And yeah, treated very differently from the tax team.
Yeah, absolutely. I think, and it's a lot of the time people are like, oh no, I paid $15,000 in deductions, or I bought something worth $15,000, it'll be depreciated. And also just remember that whatever you're claiming as a tax deduction, that doesn't mean you get that back in tax. That's
No,
usually a common myth. Oh, I'm claiming $7,000 in deductions, so I'm going to get $7,000 in tax. No, no, that's not how that works. It reduces your taxable income by $7,000. Tax is recalculated on that amount, and maybe you'll be entitled to a refund if you actually paid some tax. But then, it depends on, I guess, a lot of other factors that go into obviously those workings.
no, spot
Um,
on.
yeah, so
Spot on.
there's a
So
little bit in that one.
I think the other one I like to go through with clients too is, while you're going through this process of gathering your stuff together, look at you with current withholding tax. It's a big thing that we see a lot of people miss.
Yep.
If you've got bank accounts and you're earning credit interest on those accounts, make sure 10% is actually coming out, because if it isn't, then you are going to need to manually declare it to the ATO and pay tax at 10% on that.
Yep.
Check your dividends. Is there any withholding tax being deducted? If not, then A, your account's set up incorrectly because the registries think you're a resident, but
Mm.
B, we've seen cases where clients, when they should be paying 15, they're paying 30. So there's
Yes.
all these sort of things as well too. And these can be all cleaned up in your tax return. So, you and I like to harp on about the end of financial year, but it's pretty important because it is, once again, money in your pocket or money in the government's pocket, whichever you prefer.
Yeah, absolutely. And I think another extending that withholding tax on the dividends, a non-resident actually can't have a dividend reinvestment plan going because the DRP doesn't account for withholding tax. You should actually have the dividend paid out to you.
Yep.
So income is distributed, withholding tax comes out, and then, you can log back in and buy whatever amendment. But when you've got the DRP automatically going, it actually means you haven't set it up correctly because withholding tax isn't being calculated in that dividend at all.
Exactly. And I think that's the people are inherently lazy. I'm not saying that in a bad way, but they just want this set and forget, I've got VAS or whatever the one they got set up with an ETF just rolling. Then they move overseas and they just don't want to have to change. So unfortunately, when you elected to jump on that plane and move overseas, you do have to make a change.
Yeah, absolutely. And I think as we wind out the end of the financial year, I often find it's a good time to even just go back and hit the recalibrate button on your own finances. Go back, have I set things up? Why am I having to pay tax on my assets that I hold if I've got shares and interests? And it's very likely that, as Brett said, you haven't set things up correctly. You haven't told the financial institutions you're a non-resident. So it's a good time to recalibrate, but also do some thinking about the next 12 months, goal resetting, objectives that you want to achieve, building up assets, buying another investment property, kickstarting that investment strategy into your tax-free portfolio, putting something into super, being a bit more proactive. So it's a really good time for that goal reset as well.
I think the other one I'll put on the listeners list is, and I've seen a lot of this in the last 12 months, is people selling property in Australia. So there are things you can do. Don't just sort of blindly accept, I'm going to pay lots of tax as a non-res and sucks to be me. There are, as James alluded to before, catch-up provisions on the concessional contributions that you can access as long as your super balance doesn't exceed a certain level. And you haven't obviously previously used these limits. So there is
Mhm.
savings to be made in a lot of these areas. And, it's funny how you talk to someone and think, okay, I need you to do all this work and I'm going to save you $5,000. Like, oh, it's not a lot, is it? If you walk along the street and you saw $5,000 sitting on the ground, would you pick it up? Of course you would. It's there. You just need to give it the time to do the paperwork, to do the analysis. Obviously, we do this for our clients, so that's why they don't have to worry
Mhm.
about it. But for just general
Yep.
listeners on the call, go through and crunch the numbers and say, well, yes, I sold an investment property back in Australia. The capital gains is going to be approximately X. What can I do to try and soften that blow? Because there are things you
Yep.
can do.
Absolutely. And again, it is a good time for a reset and a good review if you've been, I suppose, lazy with your super and you've got multiple super funds as well, paying multiple fees, multiple insurance premiums, which likely won't even cover you because now you're overseas and you're not meeting the ordinary definition of an Australian
Yeah.
resident. It's time to consider that review and see whether it's worthwhile and consolidate them as well.
Oh, mate, it is. It is. It's people don't realise 9 times out of 10 they're paying a minimum admin fee, regardless of balance. So if they've got
Yep.
lots of small balances, they're essentially paying 5 admin fees as opposed
Hmm.
to one. So that's the big one
Hmm.
we see. I've got a gentleman coming on board now as a client. He's up to six, and they're all 20, 30K, 40K. One's a bigger one, but all
Yep.
the sort of rats and mice. And yeah, we're going through looking at his numbers. And it's quite humbling because
Yep.
guess what? He's paying 500, 300 to $500 per account. When you add up
Mm.
that times six, it adds up to be a
Yep.
lot.
Yeah.
So these
Oh
little
yeah,
things make a
absolutely.
difference. And because when you become an expat, your super account should be self-serving. You don't have the benefit of employer contributions going in. So it needs to stand on its own 2 feet. It needs to be able to grow unencumbered, but also too without your support. Yeah, you can always add to super, and that's one of the strategies we recommend clients do. But even if you don't add to super, the markets go up, it should be going up as well too, in a commensurate sort of way.
Absolutely. And I mean, yeah, I really like it is self-serving. And I mean, listeners need to remember that if you're not in Australia, you're not employed and you're overseas, everyone in Australia that's working full time is likely getting that 11.5% going into their super funds automatically through their pay. So if you're not doing something with your after-tax money or your savings from your wages and you're not reinvesting in setting aside a bit of a retirement fund that you're building on so you can come back and dump it into super when you repatriate, well, you're already at a loss to your counterparts and colleagues back in Australia. So you need to think differently. And that's really important. I think that was actually a key theme in the seminars that we ran last year. I think that was sort of what I was really trying to drill home to a
Yeah,
lot of the listeners and a lot of the attendees.
especially with folks in the Middle East where they don't have, I mean, there's, end of service gratuity, which is like an accrual basis of time in the company, but it's not invested. It's not compounded. So
No,
as your, if you work for a company for 10 years, they owe you a factor of your wage apportioned over those 10 years. It doesn't mean that money's put into the market and it's compounded every year for the next 10 years. So you need to be doing extra. You need to be doing all these little bits and pieces. And it's funny how you sit down with clients and talk about even the smaller strategies, dollar-wise, and they go, is it worth it? And you show them the number after 10 years. And we might be talking about sort of Mickey Mouse money on a monthly basis, but it's sheep stations after 10 years when you have that ongoing contribution combined with compounding, combined with time. That's the secret sauce.
that's right. Yeah, absolutely, mate. Absolutely. Couldn't agree more.
So, but mate, I think we leave it there. I think the people get the message. Guys and girls, you've got homework to do over the next 2 weeks. So this will be going out to on the airwaves tomorrow. So that'll be the 30th of May. So long story short, you've got 31 days to pull your finger out. Just set an hour aside. Doesn't take long. Just set an hour aside. As James said, it's a great reset. It's a great mark to market in terms of how you're going. We have this thing called confirmation bias where inherently we all think everything's going fine. But guess what? It's not unless you know it's going fine. So it's always good to have that check in and sort of say, well, okay, is it growing? Can I be doing something better? Do it because you'll be thankful for it.
Yep. Yeah, absolutely, man. And listen, time is running out. 30th of June is only 4, 5 weeks away, not even 4 weeks. So get in there, sort out that end of financial year strategy, and don't stick your head in the sand for another year.
Exactly, mate. So let's bid the folks good day. Let them get on with their jobs and their personal life, and we'll catch you around on the next episode.
Sounds good. Thanks for your time, Ben. And thanks, guys, for tuning in on another episode.
Cheers. Thanks, guys.